Alright, let's get straight into it. What if everything you've been told about property is incomplete? Not wrong, but incomplete. Because for decades, we've been sold one idea. If you want to build wealth in real estate, you must own property. A condo, a house, something physical, something you can touch, keys in your hand, title in your name. That's the goal. But what if I told you, some of the smartest property investors today don't own a single physical unit. No tenants, no mortgages, no maintenance. And yet, they are making more money than most landlords. Let's break this down from first principles. What is property investing really about? It's not about ownership. It's about exposure to real estate returns. That's it. Rental income, capital appreciation, yield. Ownership is just one way to access those returns, but it's not the only way. And increasingly, it's not the most efficient way. Let's talk about how most people invest in property. They buy one unit, one condo, one location. They take a loan. They commit 20, 25, 30 years. They hope for capital appreciation, rental income, long-term gains. But here's the problem. You are putting a large amount of capital into a single asset. That's concentration risk. Let me make this simple. If you own one condo and your tenant leaves, your rental income drops to zero immediately. But your mortgage, still running. Your interest, still compounding. Your maintenance, still due. So what are you really holding? A leveraged asset with concentrated risk. Now compare that to how institutional investors operate. They don't buy one property. They buy portfolios. Across countries, sectors, tenant profiles, office buildings, logistics hubs, data centers, retail malls, thousands of tenants. So when one tenant leaves, it doesn't matter. It's noise. That's diversification. That's risk management. And here's where things get interesting. Today, as an individual investor, you can access that same structure through REITs, through property equities. You are no longer limited to one asset. You can own exposure to dozens, even hundreds of properties with a fraction of the capital. Now, some people will say, but I prefer physical property. It feels safer. Let's challenge that. What does safe actually mean? Is it safe because you can see it? You can touch it? You can say, this is mine? Or is it safe because your risk is diversified, your income is stable, your capital is flexible? These are two very different definitions of safety. Let's go deeper. There's something most people don't understand. Institutional advantage. A large REIT or developer can borrow money at rates you will never get. They can access corporate bonds, institutional financing, massive credit lines at lower cost. Then they deploy that capital into high-quality assets, generating yield. That difference between borrowing cost and asset yield, that's profit. As an individual, you don't have that advantage. You borrow higher, you buy smaller, you take more risk. Now let's talk about something counterintuitive. Why do smart investors sometimes accept lower dividends? This is where most people get it wrong. They chase yield. High yield feels good, but high yield often comes with high risk. Smart investors don't chase yield. They chase sustainability. Let's say a REIT acquires a prime asset. To fund it, they issue more shares. Short term, dividend per share drops. Most people panic. They think, why would I invest in something paying less? But smart investors see something else. They see stronger assets, better tenants, longer leases, more stability. So they are willing to accept lower yield today for stronger income tomorrow. That's long-term thinking. Now let's shift to developers. This is where things get even more interesting. Many listed developers today are trading below their actual asset value. Let me explain. A company may own billions in land and projects, but the stock market values it lower. Why? Because projects take time, revenue is delayed, markets are impatient. So you get a situation where you're buying assets at a discount, $1 of value for 60 or 70 cents. But here's the catch. You need patience, because value is only realized when projects are completed, assets are sold, or corporate actions happen. This is not passive investing. This is strategic positioning. Now let's bring this back to you. Because all of this sounds smart, but the real question is, what should you do? First, you need to understand your objective. Are you looking for stability, growth, liquidity, control? Because different strategies give you different outcomes. If you buy physical property, you get leverage, control, potential appreciation, but you also get concentration risk, illiquidity, long-term commitment. If you invest in REITs or equities, you get diversification, liquidity, professional management, but you lose direct control, leverage at personal level. There is no perfect strategy, only trade-offs. Now here's where most people go wrong. They don't think in strategy, they think in identity. I want to own property. I should have a condo. This is what success looks like. That's dangerous, because you are making a financial decision based on identity, not math. And in property, math always wins. Let's talk about what's coming next. The market is shifting. Interest rates are stabilizing. Supply is increasing. Competition is rising. This means rental yields may compress. Prices may stabilize. Opportunities will shift. If you are locked into one asset, you have no flexibility. But if you're managing capital, you can move, you can adjust, you can reposition. This is the real advantage. Flexibility, liquidity, optionality. Let me say this clearly. Owning property is not wrong, but thinking it is the only way is. Because the smartest investors today don't think in terms of ownership, they think in terms of exposure. They ask, where can my capital generate the best return for the level of risk I'm taking? And sometimes, the answer is not a condo, not a house, not a physical unit. Sometimes, the smartest property investor doesn't own property at all. Final thought. Before you make your next move, ask yourself this. Are you building wealth, or are you just holding keys? If you want a clear breakdown of whether you should own property or invest in REITs, how to structure your portfolio based on your income, what strategy actually fits your goals and risk level, drop me a message. I'll map it out for you. No fluff, no guessing, just math. This is M.